This video here is a little bit different. It's on a sort of psychology component of trading compared to most of the indicators and tools and different things, risk management that I often talk about. Now, it's one that I call like minimum risk, maximum reward, or minimum risk, maximum opportunity. So I need to come up with a cooler name, maybe as an acronym or something. But that's essentially what it boils down to, right? Every single trade that I take, I run through this mental filter of, is this low risk, high opportunity, right? Every trade that I take, I'm always thinking that way. So what I'll do is I will take you to my trading view. We'll go have a look and I will explain some things. So it came up yesterday while I was talking to a friend. And essentially what I was saying was we weren't looking at Bitcoin on the daily, so don't go thinking this is a trade that I'm actually taking, but it's a similar concept. I thought price was going to come up here and then, plummet, go down there. And I said to my friend, all right, I'm only looking for shorts from here. He said, well, if you think it's going to go up there, why don't you long it up there and then cash the short and make some more money? And my answer to that was, it is a high risk, low opportunity trade. That long is a high risk, low opportunity trade, and I don't take them. I'm looking for the next low risk, high opportunity trade, which is this short, in my opinion. Now, the reason I'm only looking for the shorts is to do with my bias. Now, I was going to cover both these in one video, but I'm just going to do a separate video on bias, right? It's a topic that we don't need to cover today. I'll do a separate video on that. Now, what I mean when I say low risk, high opportunity is most easily demonstrated if we think about being in a downtrend, right? Because I think we're currently in a downtrend, especially if you're looking at the dailies on Bitcoin. So in a downtrend, price will usually move something like this, right? It doesn't always end in a perfect channel like this, but it will often get a channel like this happening. So what my friend was talking about was essentially taking a long off the bottom of this trend, right? And let's just, let's make some rules for these trades, right? We're gonna have two trades we look at. So let's make the rule that we enter off the trend line. We exit when the right-hand side of the risk to reward tool hits the opposite trend line. So in this case, that would be there. And we'll make our risk, let's say 2%. That's a good number. And I now getting it around one, so let's leave it at 2%, right? So you can see that long with those conditions has a 2.83 to 1 risk to reward, which is good. There's nothing wrong with that. That's a good trade. But if we look at a short and we make these the same width, so they go for the exact same amount of time, so they're the same width there, and we apply the same rules, right? So we are entering on this trend line. We are exiting when this tool, when the right-hand side of the risk reward tool hits this bottom trend line, and our stop is 2%. We'll have the same stop for both. Okay, we'll go with 2.01. I'm not going to get them both perfect. Watch what happens when we figure out where we're taking profit. So remember, we're taking profit when the right-hand side hits the downtrend, or the bottom of the downtrend. Right, we're now at a 5.36 to 1 trade. Exact same rules for both these trades, and we have nearly doubled our risk to reward, right? Which is huge. The reason for that is the sort of low risk, high opportunity mindset, right? So in a downtrend, taking this long is high risk. One, because it's counter trend, right? That's sort of an obvious one. But two, if you look at the trend line here, right? That's essentially a level of support. That's where price is bouncing off and then heading up. As time goes on, let me just get rid of that. As time goes on, that trend line gets closer and closer to our stop till it gets to the point that we can happily be stopped out, even though price hasn't broken out of the downtrend, right? So it's higher risk because our trend line is getting closer to our stop the whole time, right? High risk. At the same time, it's low opportunity because as time goes on, this upper trend line, which is a resistance level, is coming down to meet price, right? It's coming closer to our entry, which means our opportunity is being reduced. If we're expecting price to reject from that level, the opportunity is being reduced as time goes on. So it is a low opportunity trade. Now, the reverse is true for the short, because we're in a downtrend. It is a low risk trade because it's counted, it's with the trend, sorry. But it is also low risk because this resistance level, this trend line, is getting further and further from our stop, right? And it is actually pushing into profit. That's awesome. That's fantastic. At the same time, it's high opportunity because this bottom downtrend line is running away from price and running away from our entry, right? So, you know, if we were to sit in this for twice as long, we would actually make more profit. We won't make twice as much profit, but we will make more profit. So that is why the short is high opportunity, right? So it is low risk, high opportunity compared to the long, which under the same rules, 2% stop, exit at the other trend line, enter on the you know, whichever trend you're entering on. That was a high risk, low opportunity trade. So that is the filter that I'm always running my trades through, right? High risk, high opportunity, low risk. Now, to give you like another, it's a slightly different example, but it's another way that I use this concept, this low risk, high opportunity concept, is when I short, right? So let's say that we know we're in a downtrend and we're only looking for shorts. You can still apply this again with when you short. And a perfect example of this is the recent market structure. So, you know, we're in a bullish market uptrend for ages. We're making higher lows, higher highs, higher lows, higher highs. All of a sudden we made a lower low, right? This was the first lower low we'd had in months. And then we went on to make a lower high, right? So let's say that the second that the lower low formed, you turned bearish and you wanted to short the market. And so you shorted. So that would have been about here when we actually broke this level. And let's say that you were a genius and you knew exactly where price was going. So you took profit there. Let's just leave that as what it is because it doesn't really matter. You took profit there. But let's say you didn't know what was going to happen between where price was and when price got there. So you had your stop right back up above this previous high, right? That is a 1.46 to 1 trade. That's not very good. I mean, it's above 1, so it's not awful, but you have to have a pretty high strike rate with a 1.46 to 1 risk to reward to be a profitable trader. If, on the other hand, you waited until you thought a lower high was forming, right? So that's shorting the lower low. In fact, what I'll do is I'll label that with one of these bad boys. That is the lower low short. If instead you waited for the lower high to form and you shorted somewhere in here, which small brag, I did, you can see now we're at a huge 4 to 1, right? So we are more than twice as high. More like our risk to reward is more than twice as high as it was on the lower low short. They're both shorts, but because the lower low short is a higher risk, lower opportunity short compared to the lower high short. Now, the reason for that, there's a few reasons, but one of the reasons for that is every push has a pullback, right? We've all heard that saying. Shorting the lower low, you haven't had the pullback yet, which means that your risk is increased because at some point that thing is going to have a pullback. So it's higher risk. At the same time, if you look at the difference from the higher, actually, hang on, sorry, let me just label that bad boy. From the lower high short, if you look at the difference from the lower high short entry to the lower low short entry, there you go, 12% more opportunity, right? So this lower low short is also a low opportunity trade. So it's higher risk and it's lower opportunity. The lower high trade is higher opportunity because you just saw we've got 12 or 13% higher entry, right, to the exact same target. So that's higher opportunity, but it's also lower risk because if every push has a pullback, right, we've had the push, the pullback. Now you can consider this the push, which means at some point that move has to pull back, right? Moves don't go on forever. I mean, this thing could have kept going, but the probability gets lower the higher it comes. So that means that trade was lower risk. And like I showed before, it was higher opportunity. So that is essentially the concept that I run all my trades through, right? And it's one of the concepts, or one of the moments when I started implementing that sort of filter that I can point to and be like, yeah, my trading got noticeably better with that one simple trick. You know, not to be too clickbaity, but this one simple trick. I hope that's cleared things up. I hope that's cleared things up for you guys, or taught you something new. When I showed my mates this yesterday, I could see it blowing their mind. It was really sick to see that light bulb moment and to be able to help them out. So I really hope that some of you guys get the same sort of lesson from it, or whatever it may be. If you use it going forward in your trading and it helps you, let me know. I love hearing about that. And happy trading. Hope you're all having a great week.